People still believe real estate is the safest and most reliable way to get rich. You buy a house, it goes up. You rent it out, you make passive income. Simple, right? But here's the part nobody likes to talk about. What if the safe investment you've been told to trust isn't actually safe anymore? Because at a recent Berkshire Hathaway meeting, Warren Buffett, someone who rarely comments on real estate, gave a warning that most people completely missed. And honestly, it changes everything. In this video, we're breaking down why Buffett no longer sees real estate as the golden ticket, how today's market is completely different from 2012, 5 simple lessons that can help you avoid bad deals and invest smarter, why stocks often outperform real estate, especially right now, and how regular people like us can still use property wisely. By the end, you'll know exactly when real estate makes sense and when it doesn't. Let's get into it. Buffett openly said real estate just isn't as attractive today. Why? Because you're buying at high prices with high interest rates for low returns. Back in 2012, interest rates were cheap, prices were crushed, and Buffett said buying single-family homes would be a no-brainer. Imagine buying a house for half its value at record low financing. Of course you'd make money. Today, the conditions are completely different. I remember buying my first rental years ago. Even I didn't fully understand how much interest rates change the outcome, but now it's impossible to ignore. Most people assume real estate always goes up. It doesn't. It goes up when the environment supports it, and right now, it doesn't. Buffett also pointed out something most investors avoid admitting. Real estate is not passive. It takes work, negotiation, repairs, maintenance, tenant issues, paperwork, stress. You don't just buy it and chill. Meanwhile, with stocks, you click a button. That's it. No drama, no midnight calls because something broke. Most people underestimate how exhausting real estate becomes once they own more than 1 or 2 properties. I've been there. The constant repairs and unexpected problems drain both time and energy. Buying a stock during a dip takes seconds. Buying a house takes weeks, and that's if everything goes perfectly. If you think real estate is easy money, you're setting yourself up for frustration. Here's where Buffett becomes brutally honest. Historically, U.S. real estate grows around 4.3% per year. That sounds fine until you realize inflation averages around 3%. You're barely winning. Stocks, on the other hand, average more than 10% long-term, and rental income isn't pure profit. Taxes, insurance, maintenance, vacancies, and rising costs take a huge bite. Leverage used to amplify returns, but when interest rates are high, it does the opposite. A friend of mine once bought a cash flow property that made $400 a month. It looked great on paper until the roof needed replacing. One repair wiped out more than a year of profits. This is why Buffett focuses on net returns, not the attractive gross numbers everyone loves to brag about. Now here's the part most people misunderstand. Buffett never said real estate is bad. He said stocks offer better opportunities, especially during downturns. Housing crashes are rare. 1929, the early 1990s, and 2008. That's almost nothing across a century. But stocks, they dip, correct, or crash every few years, which means more chances to buy great companies at bargain prices. When real estate becomes undervalued, stocks usually fall even harder, creating even bigger opportunities. Buffett has always followed one idea: where can I get the best return with the least effort? Almost every time, that answer is the stock market. Waiting for the next big real estate crash is risky. It might not come when you need it, but stock opportunities appear frequently. Still, this doesn't mean real estate is useless. Buffett wasn't predicting a crash. He was explaining that today's prices and today's rates make real estate less rewarding. Real estate works when the price is good, the financing is favorable, and you're patient enough to hold it long term. That's it. Real estate still provides stability, a place to live, rental income, and protection against inflation, but you must understand your market and your numbers. Buffett avoids real estate because stocks give him higher returns with less effort. For everyday people, real estate can still be part of a smart wealth plan, just not blindly and not at inflated prices. Buying because everyone else is buying is how people get stuck. Buy because the numbers make sense, not because it looks like passive income. Let's quickly recap the biggest mistakes Buffett wants you to avoid. 1. Believing real estate always beats inflation. It doesn't. 2. Thinking leverage is always good. It isn't when interest rates are painful. 3. Assuming real estate is passive. Even passive rentals need active management. 4. Buying emotionally. Stocks don't care about your feelings. Real estate sellers do. 5. Ignoring stock market opportunities. Most long-term wealth is built during market downturns, not when everything is overpriced. So here's the bottom line. Buffett isn't predicting a housing crash. He's warning that today's environment makes returns smaller. Real estate used to be a bargain. Now it's not. Stocks offer more opportunities more often. And real estate still works, but only when you buy smart, patient, and with a plan. Don't fear real estate, but don't romanticize it either. Run the numbers, stay rational, and put your money where the real opportunity is, not where emotion pushes you. If you learned something today, do one thing. Don't invest on autopilot. Look at your options, run the math, think like Buffett, calm, rational, and focused. If you enjoyed this breakdown, hit the like button, subscribe for more practical money lessons, and let me know in the comments, do you think real estate is still worth it today?